The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money. And with me on the line from Vienna, I'm very pleased to have Ronnie Stoeferle, who is a returning guest. Ronnie was working with Erste Bank, but I think still writes reports for them, but has set up a separate fund called Incrementum. And I'm sure Ronnie will put me right if I've got that wrong. Welcome to the show, Ronnie.
Hi, Alistair. Thanks for having me again.
You're still writing for Erste Bank, I think, aren't you?
Yes, I'm currently in the process of collecting data, doing charts. I'm starting to write at the moment, and the next report will be published on June 27th.
Right. So you must actually have a fairly good idea in your own mind as to how the report will be structured and the sort of information in it. I mean, it's been a very active year, hasn't it?
Absolutely. I mean, the thing is that this time I'm only allowed to write roughly 30 pages. And my big problem is that I think I could write 200 pages with all the developments going on in not only in the precious metal sectors, but in the economy and the financial system itself. But yeah, plenty of stuff to write about.
Absolutely. And how's your new fund, Incrementum? How are you doing with that?
We're basically in the process of setting the company up. We're 7 partners, most of them from Switzerland. And the company will be incorporated in Liechtenstein. I also moved to Vorarlberg, which is next to the border. And yeah, then we'll launch a fund which will be based on the Austrian School of Economics, basically, and we're having a thematic approach. And as you probably would know, precious metals will play a pretty central role in this fund. But yeah, I can tell you a bit more in about 2 or 3 months.
Right, excellent. Okay, well, I wish you all success with it.
Thank you.
Talking about Austrian economics, we have, I think, a continuing deterioration in the global economic conditions since we last met in Vienna and since we last talked, indeed. I don't know what your take on it is, but I see the banks are still very, very delicate, if you like, and governments can't raise the money to bridge the gap on their budget deficits without having to print it or getting their central banks to print it, which is essentially, I think, the position the Weimar Republic found itself in back in 1920 to 23. Would you broadly agree with that, or have I got it wrong?
No, that's totally right, and I think it's we're traveling some sort of a narrowing road with inflation on one side and deflation on the other side. And as you and probably everybody interested in the Austrian School of Economics would suggest is that this current process that would happen without interventions by central bankers and politicians would be extremely deflationary. So I think we're kind of bouncing from one side to the other side with some sort of increasing force. I think at the moment we're having lots of deflationary pressure in the system. You can tell that basically by the commodity prices being very weak, gold-silver ratio showing increasing or decreasing relative strength of silver versus gold. We're seeing that the bonds, especially the inflation protected, the TIPS, are coming down. So the market in general is playing deflation now. But as we all know, central bankers will do whatever it takes to avoid the deflation because, basically a deflationary cleansing process would be lethal to the system, which is based on debt at the moment. So what we are basically seeing at the moment is that there are already rumors that the Fed might increase quantitative easing. Mr. Bullard just said that he's concerned by inflation being too low. There are lots of commentators suggesting that the Fed should even do more. So I'm pretty certain that when it comes to gold, the current correction will be pretty soon be over, because, as I've said, central bankers will do whatever it takes to avoid deflation.
Yes, that's very much my take on it. I mean, after all, Helicopter Ben Bernanke didn't get that sobriquet for nothing. He got it by saying that at the end of the day, the Federal Reserve Board can produce as much money as it takes, and they will replace contracting bank credit with freshly minted money. So I think that's right. I mean, the deflationists, it seemed to me, have a point insofar as you rightly say, there are strong deflationary forces in the economy. And indeed, that has been the case, I think, since the banking crisis. But we're now in a situation, really, where the outcome, if they continue with current policies, is bound to be hyperinflationary, or leading to the collapse, if you like, of paper currencies. That is the end result, isn't it, Ronnie?
Absolutely. I mean, I think Dylan Grice wrote a brilliant piece about the connection between monetary inflation and trust. And basically, money is also based on trust. And when you're debasing money, you're debasing trust. And nobody can estimate when this trust finally collapses. But I think what we have seen recently with the whole Cyprus thing, that really was some sort of a negative milestone in the whole story. I'm presenting quite often, and a few years ago, people after my presentations, people were asking, okay, what do you say about silver? Would you rather recommend buying silver, or what about the mining stocks, and what's your price target for gold? And nowadays, after the presentations, people are really concerned about hyperinflation. They're asking me where to store their gold. They're asking me if I'm thinking about, riots on the streets, civil wars, and all those very dramatic scenarios. And I think with the whole Cyprus story, the concerns became even bigger, and that's what we're basically also seeing with the physical demand for gold. I talked to a lot of physical gold traders, and they said since these decisions were made about Cyprus, the demand is just going crazy, and we've seen the same with the current takedown. I think nobody would have expected that physical demand during such a correction would increase dramatically like it happened.
Can I stop you there? Because you're saying something very, very interesting. What you're saying is that the rush into gold actually started with the Cyprus event rather than the knockdown in the price of gold and silver in April. The knockdown in the price of gold and silver in April merely accelerated it. Am I understanding you correctly?
Yeah, that's basically what I'm hearing from physical dealers in Germany and in Austria. And it basically went parabolic with all the with the crash in April, but it started picking up definitely after the whole Cyprus.
In the wake of Cyprus. Now, that is fascinating because we hear stories, and of course these things, are never confirmed, but we hear stories of shortages in London in particular. We hear stories about banks like ABN AMRO writing to their customers with gold accounts, I mean, presumably these are unallocated gold accounts of some sort, and saying that we can only settle in cash. If Cyprus triggered a rush into bullion, then that would make sense of these anecdotal reports. I mean, I don't know whether you can comment on that.
Yeah, that's totally true. I mean, there's lots of different stories and aspects about the whole takedown that happened in the price of gold, and we've been reading a lot. We've been talking about this takedown for quite a while, and the only thing that I can say is that Cyprus was not responsible, or the possible sales of the central bank reserves from Cyprus did not have any impact on the price of gold. I think
it was a very small amount, isn't it? I mean, I can't remember. I think it was something like 12, 13 tons or something.
Yeah, it's 2% of the daily trading volume at the LBMA.
Yeah,
I think there were really strange things lining up. You already mentioned ABN AMRO. Then we had the Fed minutes that leaked out few hours afterwards. Goldman Sachs issued an extremely negative and aggressive sell recommendation. We had Societe Generale downgrading gold. We've seen CIBC downgrading gold. Who else? Credit Suisse said it's a wounded bull and the bull market is probably over. And then what happened on Friday? I mean, the 1530 was a really obvious support level, and we went through the support level in very thin late trading with massive orders. And then immediately, there's CTAs, managed futures, all this algo trading and so on. And they sort of increased this downtrend. And then what's normally happening from a psychological point of view during a weekend, people are reading in the newspapers, gold price collapsing, new price target, I don't know, $200. So everybody is getting nervous during the weekend. And what's the way to play it? You call your broker, or you just sell your gold position.
sell, yes.
And that's just a very, very normal herd behavior.
Yeah, but it didn't work out like that, Ronnie, did it? Because you had a very strong bounce towards the close, and silver, which we know the paper market people are very short of and can't close their shorts. Silver actually ended up on the day by a fair margin.
Yeah, that's true. But I think what we've then seen on Monday was a typical panic low. We've seen extremely high volume. I think it was like 50% higher than the last all-time high in volume traded at the COMEX. I think I got calls from people that haven't called me for decades, being really nervous and saying, "Oh, what's going on with gold? Is it collapsing now? Is the bull market over?" And that's normally a panic low, but what's really encouraging for me is the fact that, as we've said before, that the physical demand is that high, and we're seeing it not only in Europe, we're seeing it all over the world. We're seeing it in the US, we're seeing it in Australia, we're seeing it especially from Asia. So I think this is for the first time that really on a global basis, people are starting to react in an anti-cyclical way, because normally they tended to act very pro-cyclical. So with every new high, they started buying, and as soon as it dropped or corrected, they started selling. And now we're seeing the complete opposite. And that's very new, and that's a very good aspect from my point of view.
Yes, and I think that the bullion it caught the bullion banks very much by surprise. But do you think this is because we're so used to thinking like investors rather than people who actually question whether real money is government currency or whether it's gold. In other words, if, going back to what you were saying earlier about the confidence factor in paper money, if paper money loses that confidence and collapses, it's no longer money, whereas that never happens with gold, full stop. So if people start thinking again that actually gold is the only money which actually does make sense, then you can understand why they would buy it very heavily on any dip. I mean, they're not driven, if you like, by market sentiment, which is very much investor related. The idea that, if prices fall, perhaps I've got to rethink my strategy and perhaps I should sell and cut my losses. That doesn't enter into it with sort of Indians and Chinese who, have a long history of having their savings all in precious metals, and they've done very well. I mean, do you think there's a sort of battle between the Western investor mentality, if you like, and that I want long-term protection type mentality, which is prevalent in Asia?
That's a difficult question. I think that I don't like the differentiation between, the smart money and the dumb money. I've met a lot of institutional investors, and I don't see any big difference in their sophistication or in their market timing compared to the so-called dumb money. I think they're just trading larger books. Yeah, it's just they're moving much more money. But I think that the as the Americans call it, the Joe Sixpack, the guy from the street. People are realizing what is happening at the moment, and I've met many people that I talked about the Austrian School of Economics and what the current monetary inflation will lead to, and they understood it. And I think a 5-year-old can understand that printing your way out of into prosperity will not work. That increasing those type of QE programs will not work, especially because the last few rounds didn't have any big effect on the economy itself. So I think what we're seeing at the moment, we're seeing massive asset price inflation. It's not only on the stock market at the moment. We're seeing it, in wine. We're seeing it at art auctions. We're seeing it in real estate. It's going crazy basically all over the world. Bitcoins, very, very interesting topic from my point of view. So we're already seeing this monetary inflation. As you know, the so-called Cantillon effect is showing that money production is not neutral, and the new money spills into the economy and in sort of a different speed and strength. And normally, as Rothbard would suggest, the next phase will be consumer price inflation. And I'm absolutely certain that we will see that, and that central bankers would have to massively decrease the monetary aggregates many months before. But I'm absolutely certain that they will be too late. And as you know, it's a bit like the so-called catch-up inflation. Yeah, it's you knock on the ketchup bottle a few times, nothing happens, and then it all spills out, and it's really hard to get it in again. So
it's the old saying: "Shake and shape the ketchup bottle, none will come, and then a lot'll."
Yeah.
No, that's absolutely right. I mean, I think that if I can just pick you up on one thing you were saying, what is interesting is how difficult people find it to see how inflation is going to come back. I mean, by inflation, I mean price inflation, the rise in prices. Now, we do know that governments tend to underreport inflation. There's enough evidence around the world, not just Argentina, that confirms that statement. But in general, I think I think what you're saying is that not only from the Austrian theoretical point of view, but also empirical evidence shows that after a period of time, if you have a monetary inflation, then it does begin to leach into prices through, as you say, the Cantillon effect. In other words, where the money is spent and where it enters the economy, those are the prices it drives up first, and then it sort of goes from there. And in a sense, perhaps we're already seeing this, because if you look at London, for example, the beneficiaries of fiat money, who are oligarchs, bankers, and all the rest of it, are driving up property prices hugely in London, whereas in the rest of the country, there's nothing. I don't know whether you get much of that effect in Vienna.
Yeah.
But it's very much it's difficult, I think, for many people at this stage to see quite how inflation is going to take off, because they assume that inflation is always tied to demand for goods. Now, my understanding of Austrian economics is that it actually quite simply explains why that is not the case every time. Would you think? I mean, do you feel that you need to have a pickup in demand, or if you like, commodity prices of goods and services could start rising without that real pickup in demand? In other words, could we have a stagflationary outlook?
Definitely. I mean, we've seen it in the 70s. We've seen high unemployment in the 70s. We've seen high inflation in the 70s. So I think I don't really believe in those concepts of output gaps and so on. And I don't know what the trigger will be, if it's going to be energy. I mean, from a geopolitical point of view, there's so much going on at the moment. I think the whole geopolitical environment is that fragile at the moment that there might be some big thing happening soon, and then we would see energy prices going up dramatically, perhaps a bit like in the 70s. But I think what's really important, if we make this comparison with the 70s, I think the reasons for the consumer price inflation and for also this monetary inflation in the 70s was in the 60s. In the 60s, we've seen a massive growth of the monetary aggregates, and you only saw the effects in the 70s. So perhaps it's a bit similar now. And I mean, with all the experiments going on a global basis, I mean, it's not only the US, it's also UK. I'm really curious what Mr. Carney is going to do, and I think the Canadians are pretty happy that he left the country. I think what we're happening in Japan at the moment, I mean, that's monetary harakiri. Nobody will really knows how this will end. But from my point of view, I think Hugh Henry once said that. I don't know the last 100 pages of the book, but I know. I completely know how the book will end, and when you compare that saying to Japan, it's gonna end horrible. And I mean, if even countries like Cyprus, Greece, or Slovenia, which is getting a bit bigger problem nowadays, are really a big threat to the system. What's gonna happen if Japan finally blows up? I mean,
well, that's a very good question. I mean, we've seen Japanese bond yields spiked up last week quite sharply, and the yen went through the 100 to the dollar and just kept on going. I mean, this is very worrying, isn't it?
Absolutely, and I think it's really funny that most of the mainstream is really cheering to this Abenomics and Mr. Kuroda at the Bank of Japan. I think it's that's definitely the end game. And what we're seeing in Japan now, I think that's the only way to within some more months or perhaps years, but the reasons for the instability and this situation are in the past. And I'm always saying that what we're seeing now on a global basis, it's not about Lehman Brothers, it's not about Greece, it's not about the Eurozone. I think the real problem started on 15th August of 1971, and this is just the end game of a systemic failure.
Yeah, that was the Nixon shock when America came off any version of gold convertibility whatsoever. The 71 event. And really, I think putting another way, what you're saying, Ronnie, is that the central banks have had no restriction on the issuance of currency from that time, and that is the source of our problems today.
Absolutely. I mean, if you compare like from 1971 until now, total credit market debt is up by 35 times. The GDP per capita on a inflation adjusted basis is only up by 65%. If you compare industrial production, GDP and numbers of the, if you will, the real economy, you can see that there's, since 1971, there's just a decoupling from financial industry, debt creation, to the real economy. And at the moment, as we said at the beginning, the normal process would be highly deflationary. But in this system, deflation would be lethal. And Jörg Gude-Hulsmann said a very interesting thing about the differentiation between deflation and inflation. He said the true crux of deflation is that it does not hide the redistribution going hand in hand with changes in the quantity of money. It entails visible misery for many people to the benefit of equally visible winners. This starkly contrasts with inflation, which creates anonymous winners at the expense of anonymous losers. And that's basically what the Cantillon is already is describing. And therefore, I think that the whole disequilibrium between the richest 1% and the poorer getting poorer from day to day, the reasons have to be found or searched in the monetary system. And as I said, I think this whole mess started in August 1971.
Well, I think that's a very, very interesting note to end on, and I'm sure our listeners will reflect on that statement. The other thing that I think has come out of this, which is very interesting, is the relationship between Cyprus and the knockdown in the gold price somewhat afterwards, and the potential links in terms of the reasons why those two, well, we know why the first event happened, but did it lead to the second event? Ronnie, thank you very much indeed for taking the trouble to talk to us. And how can our listeners find out a bit more about you? I mean, have you got a website for Incrementum yet, or do they still pick up your reports from Erste Bank?
It's not online yet, because we're in the process of setting everything up, and financial authorities are very strict these days. So it will be online probably in 2 or 3 weeks, and our funds will be launched probably by July or August. And the report will be presented on June 27th. And I'm sure that you can just find it very easily by Googling it. And yeah.
Yeah, that's
It's going to be called In Gold We Trust again.
Right, okay. Ronnie Stoeferle, thank you very much indeed. And we will do this again at some stage in maybe a few months' time.
Absolutely. Thank you very much, Alistair.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.